Hi. Let's learn about income in respect of a decedent, IRD definition and taxes. Income in respect of a decedent refers to untaxed income that a decedent had earned or had a right to receive during their lifetime. IRD is taxed to the individual beneficiary or entity that inherits this income. However, IRD also counts toward the decedent's estate for federal estate tax purposes, potentially drawing a double tax hit. The beneficiary may be able to take a tax deduction from the estate tax paid on IRD. The beneficiary must declare IRD as income for the year in which they received it. IRD is defined in Internal Revenue Code, Section 691. Sources of income include any unpaid salary, wages, or bonuses that the decedent was entitled to receive at the time of death. Other sources are unpaid commissions, fees, and royalties that were earned but unpaid at the time of death. IRD is taxed in the same way it would have been taxed upon the decedent if they were still alive. For example, capital gains are taxed as capital gains, and uncollected compensation is taxed as ordinary income on the beneficiary's tax return for the year they received it. There is no step-up in basis for IRDs. Other common examples of IRD are distributions from tax-deferred qualified retirement plans such as 401s and traditional individual retirement accounts, IRAs, that are passed on to the account holder's beneficiary. If an individual dies leaving behind a $1 million IRA to his beneficiary, the beneficiary will be responsible for paying taxes on any distributions made from the account. The beneficiary may have to start taking required minimum distributions, RMDs, at a certain point. Either way, each beneficiary has specific RMD rules to follow and is liable for applicable taxes. If you as beneficiary received such income, you'll report it on your personal income tax return for the year that you received it. Inheritance is property bequeathed to you by a decedent. Income in respect of a decedent, or IRD, is income that was owed to the decedent but wasn't received by them due to their death. Instead, that income may go to the beneficiary. For example, a required minimum distribution from an IRA will go to you, just as the decedent would have been. For example, an RMD from a traditional IRA would have been reported by the decedent as regular income and taxed as such. The beneficiary will report the RMD in the same way and will owe tax that corresponds to their income tax bracket. Here are 3 key takeaways. 1. Income in respect of a decedent, IRD, refers to untaxed income that a decedent had earned or had a right to receive during their lifetime. 2. IRD is taxed as if the decedent is still living. 3. Beneficiaries are responsible for paying taxes on IRD income under most circumstances. Hope this would help. Thanks for watching.